And Brandis, it's not just rideshare that's more expensive right now. You may have noticed the dollar isn't buying quite as much of a lot of things as it used to. The Bureau of Labor Statistics says the overall level of inflation is 5.4%, well above analysts' estimates and the Federal Reserve's target of around 2%. Some of that is driven by temporary factors related to the pandemic, such as a 45% rise in used car prices, but other factors may not be so temporary. So what do these inflationary pressures mean for the economy and your wallet going forward? Joining us to help us unpack all of this are Ed Stewart, Emeritus Professor of Economics at Northeastern Illinois University, Luigi Zingales, Professor of Entrepreneurship and Finance at University of Chicago Booth School of Business, and Rachel Gressler, Research Fellow on Economics, Budget, and Entitlements at the Heritage Foundation. Welcome all of you to Chicago Tonight.
Good evening, Paris.
Good to see you. So let's go through some of these costs. Inflation, as we mentioned, up 5.4%. Gas up 45% over the last year. Used cars 45% as well, 10% in the last month alone. Dining out 4.2%. Food 2.4%. Ed Stewart, what are the culprits here?
I think one of the phrases I use to explain this is bounce-back inflation. Like you've already said, not only are used car prices up, but airline fares are up 24.6%. Hotels are up 16.9%. These were sectors of the economy where there was deflation during the pandemic, and now with the vaccination effort semi-successful and people with some money in their pockets because of stimulus and savings during the pandemic, demand is going faster than supply, and you're getting what I think is going to be temporary inflation.
And so you're saying temporary inflation. Economists at the Fed have said temporary inflation. Luigi Zingales, how long is temporary, and do you believe that?
So certainly there is a temporary component, but let's do this quick calculation. If prices were not to rise from now to the end of the year, we will already be at 3.6%. If prices were just to rise the same level for the rest of the year, we're doubling to 7.3%. So we're way above anything that anybody has expected at the beginning of the year, anybody that at the Fed has expected, even anticipating this bottleneck. So I think that there is a concern. The concern is not as large as to say we should act now. But what I am afraid is of the fact that the Fed does not seem to be afraid. In fact, paraphrasing Roosevelt, I would say that the only thing to fear is the lack of fear itself.
The lack of fear from the Fed. So you're saying you don't think the Fed is taking it seriously and they're not going to take action, or at least it doesn't seem like they are. Rachel Gressler, at what point do you think the Fed does have to step in here and attack some of these inflationary pressures or government policy? When should they step in?
Yeah, well, I think that government policy should have stepped out of the way quite a while ago, because I think that there's this artificial bounce back component also, and that has been spurred on by 3 rounds of stimulus checks, supersized unemployment benefits that are now available a year and a half after the pandemic began. And so it's no wonder when you have the federal government simultaneously increasing demand by pumping this money into the economy and then restricting the supply of available workers to meet that demand by offering these supersized unemployment insurance benefits. You know, it's not rocket science here to see how that is weighing on prices. And that could continue beyond just the short term if we see these policies go beyond the pandemic. And we're already talking about $3 to $6 trillion in so-called infrastructure projects. Employers are already having to compete to get the workers they need. They don't need a jobs package creating millions more new jobs when we already have a record high number of job openings out there.
And especially, Ed Stewart, in the hospitality industry, the restaurant industry, we've talked to so many people that cannot find workers. So it's this weird situation where there are inflationary pressures and many, many jobs open that are not being filled. What's going to change that situation?
Well, what's going to change it is basic economics, supply and demand. Wages are much too low. Employers have been used to getting employees at rock bottom prices and not paying benefits and having irregular schedules. And power, fortunately, is being shifted, at least in part, to the labor supply side, to workers, and they have a little bit more bargaining power now And what's going to happen is that employers are going to have to start paying fair wages and treating employees like human beings, which they haven't done, especially in leisure and hospitality, for a long time. So I think this labor shortage is a good thing.
Well, so Ed, you're saying the wages are the problem. Rachel, you're saying the extended unemployment benefits. Luigi Zingales, where do you fall on this? So why is there such a labor shortage? Is it all of the above?
I think it's all of the above. I think there is no doubt that unemployment benefits allow people to look harder for the best job, and so they take longer to go back to the workforce. It's also true that there is still a lot of disruption because a lot of schools are not in full swing. So childcare is a huge issue, and so a lot of people cannot provide a full amount of of labor they want because they have to stay home with the kids. And I think that what Ed is saying is certainly true that this helps raising wages, but if the wage raise in nominal terms less than inflation, at the end of the day, workers are worse off, not better off. So, and in the last couple of months, what we have seen is very high increase in prices and not equal increase in wages.
And
Rachel, I think that's the point. We all would like to see rising wages, and we want, especially at the lower end, for those individuals to have that upward mobility and a chance to climb that ladder of opportunity. But you have to face the other side of that. And the reality is that higher wages lead to higher prices. Things like the cost of childcare, if that's weighing on the recovery, higher wages for childcare workers equals higher costs for childcare for families. And I did an estimate just of the $15 minimum wage, and that increasing childcare costs by 21%. We're talking about over $3,000 more for an average family with 2 kids. And so there are both sides of the equation here going forward.
And Rachel Gressler, you kind of alluded to this in the last year, about $5 trillion in government stimulus spending to kind of prop the economy up. What happens when that starts to peter out and the economy just kind of has to surge forward on its own?
Right. And so talking about over $40,000 per household that has been spent over this past year, but that's all deficit finance spending. That's got to come out of somewhere in the future. And so while now the federal government is helping to stimulate the economy, it's going to have to pare that back going forward. And already we have the factor of potentially higher inflation that could lead to higher interest rates. And then the Federal Reserve increasing interest rates, leading to higher costs on the deficit, and you get this downward spiral. So there are significant risks out there.
All right, Luigi Zingales, you're afraid here that the Fed is just not going to act. At what point do you think the Fed has to start thinking about acting?
So I think that the next few months will be crucial because I think there is a lot of truth in what Ed said, that there are temporary elements in this rise. But if we see that this is continuing for a couple of months longer, and if we see that this starts to be embedded in the expectation of economic operators, I think that the Fed should intervene. My fear is that I don't see the Fed so attentive of this. They seem to be relaxed. They, in fact, moved to a target of 2% over a long period of time, and because we undershot inflation for a while, there's plenty of room to overshoot inflation for a while. And politically, I see a huge demand for inflation because that would reduce the debt of students, reduce even the government debt in real terms. So I see a lot of pressure for inflation to go around to be contained.
All right, some of the upsides of the current inflation situation. Our thanks right now to Edward Stewart, Luigi Zingales, and Rachel Gressler. Thank you so much.
My pleasure.
And up